The Great Recession of 2008. Unraveling the global economy. Welcome to an exploration of one of the most significant financial crises in history. The Great Recession of 2008. In this video, we'll delve into the causes, consequences, and key figures that shaped this global economic downturn. So let's embark on this journey to understand how the world faced an unprecedented challenge. It all began with the collapse of Lehman Brothers, a prominent investment bank on Wall Street. The event triggered a chain reaction that reverberated throughout the global financial system. However, the roots of this crisis can be traced back to a combination of factors that had been building for years. Prior to the recession, the housing market experienced an unprecedented boom, fueled by loose lending standards and a wave of subprime mortgages. As more and more homeowners defaulted on their loans, the market crashed, leaving a trail of devastation. The collapse of the housing market was just the beginning. Financial institutions, burdened by toxic mortgage-backed securities, faced insurmountable losses, leading to a crisis of confidence in the banking sector. Governments around the world scrambled to prevent the complete collapse of their economies. Central banks implemented emergency measures, and governments injected massive amounts of capital into struggling financial institutions. Despite these efforts, the global economy slipped into a severe recession. The impact of the Great Recession was felt far and wide. Unemployment rates soared, and millions of people lost their homes, jobs, and life savings. Stock markets tumbled, and consumer spending plummeted, further exacerbating the economic downturn. Let's take a closer look at some facts and figures that illustrate the magnitude of the Great Recession. Between 2007 and 2009, the global economy contracted by 0.1%, marking the first global recession since World War II. The U.S. stock market lost approximately $8.4 trillion in market value during the crisis. In the United States, the unemployment rate reached a peak of 10% in October 2009, the highest level since 1983. Around the world, more than 8 million people lost their jobs, pushing the global unemployment rate to 6.6%. The International Monetary Fund estimated that the cumulative loss of output from the crisis amounted to $4.1 trillion. The Great Recession not only caused economic turmoil, but also sparked social and political consequences. Frustration and anger among the affected population led to widespread protests and political movements, demanding accountability and systemic reforms. Governments and international organizations worked tirelessly to stabilize the global economy and prevent future crises. New regulations were introduced to strengthen financial oversight and enhance consumer protection. Gradually, economies started to recover. Through a combination of fiscal stimulus, monetary policies, and structural reforms, the global economy regained stability, albeit at a slow pace. However, the scars of the Great Recession lingered for years. Lessons learned from this crisis shaped economic policies and regulations for the future, aiming to build a more resilient and stable financial system. The Great Recession of 2008 serves as a stark reminder of the interconnectedness of our global economy and the importance of responsible financial practices. As we move forward, it's crucial to remain vigilant, learning from history to build a more secure and prosperous future.